Welcome to the world of stock market trading, a world where fortunes are built, lessons are learned, and where discipline meets opportunity. If you're a complete beginner trying to understand how the stock market works, how to buy and sell stocks, or simply wondering where to begin, you've landed on the right video. In this detailed beginner's guide, we'll walk you through everything you need to know, from basic stock market concepts to setting up your trading account, understanding chart patterns, managing risk, and building a trading mindset that lasts. No fluff, no hype, just step-by-step guidance in simple, understandable language, even if you've never heard of stocks before. So grab a notebook, stay till the end, and let's get started on your journey to becoming a confident and informed stock trader. What is the stock market? Let's begin with the most fundamental question. What exactly is the stock market? At its core, the stock market is a marketplace where buyers and sellers exchange ownership of companies through what we call shares or stocks. When you buy a stock, you're essentially buying a small piece of a company. Companies issue shares to the public to raise capital, to grow, expand, or invest. In return, traders and investors get the opportunity to benefit from that company's success. The stock market operates through various exchanges like the New York Stock Exchange, NYSE, or NASDAQ in the United States. There are also international exchanges like the London Stock Exchange, Tokyo Stock Exchange, or Bombay Stock Exchange. Prices of stocks change constantly based on supply and demand, which are influenced by news, earnings reports, economic data, investor psychology, and even rumors. Understanding this dynamic, that price moves because of buying and selling pressure, is key to everything else we'll discuss. Trading versus investing. What's the difference? Many beginners confuse trading with investing, but these are two very different approaches. Investing is long-term. Investors typically hold stocks for months or years. They focus on fundamentals such as the company's revenue, growth, leadership, and future potential. Investors want to build wealth slowly over time. Trading, on the other hand, is short-term. Traders focus on price movements, technical analysis, and volatility. A trader might hold a position for a few minutes, hours, or days. The goal is to profit from short-term price fluctuations. If you want quick opportunities, love reading charts, and don't mind managing risk, trading might suit you. If you prefer slow, steady wealth accumulation and less screen time, investing might be better. You can do both, but knowing your style helps shape your learning. Types of trading: which style fits you? There are four main types of trading styles, and each has a different time horizon. 1. Scalping, extremely short-term trades, often held for seconds or minutes. Traders look for small price movements multiple times a day. 2. Day trading, positions opened and closed within the same day. Traders capitalize on intraday volatility. 3. Swing trading, positions held for several days to weeks. Traders ride small trends and retracements. 4. Position trading, a longer-term style, closer to investing. Traders hold trades for weeks or months based on strong market trends. As a beginner, swing trading is a popular choice. It's slower than day trading, gives you time to analyze trades, and doesn't require staring at charts all day. Each style needs different strategies and risk management rules. Take time to test and find what suits your personality, time availability, and risk tolerance. What you need to start trading. Before you start placing trades, here's what you'll need. 1. A reliable broker. Choose a regulated broker that offers fast execution, a good trading platform, low fees, and strong customer support. Make sure they provide a demo account so you can practice without risking real money. 2. Trading platform or app. Most brokers provide built-in platforms. Alternatively, many traders use TradingView for charting and analysis. 3. Charting tools. These include candlestick charts, indicators, drawing tools, and news feeds. 4. A solid internet connection. Latency matters, especially in day or scalp trading. 5. Risk capital. Never trade with money you cannot afford to lose. Start small. Even $100, $500 is fine for practice. 6. A notebook or trading journal. Record your trades, mistakes, emotions, and results. This helps track progress and avoid repeating errors. Understanding charts, the trader's language. Charts are the language of the market. And to trade successfully, you must learn to read and interpret them. Most traders use candlestick charts, which display the open, high, low, and close of price over a specific time frame. Each candle tells a story of buyers versus sellers. Here are a few basics to master. Bullish candles show buying pressure, price closing higher. Bearish candles show selling pressure, price closing lower. Wicks represent price rejection or volatility. Doji, engulfing, and pin bars are common reversal signals. Also learn how to identify trends, higher highs and higher lows. Support and resistance zones, breakouts and fakeouts. You don't need to memorize 100 patterns. Learn a few and master reading market context. Pro tip, use multiple time frames. For example, check the 4-hour chart for direction, then the 15-minute chart for entry. Popular strategies for beginners. You don't need a complex strategy to win. In fact, the simpler, the better. Here are a few beginner-friendly strategies. 1. Break and retest. When price breaks a key level, support or resistance, wait for it to come back and retest that zone. If it holds, enter the trade. 2. Moving average crossover. Use the EMAs, say 9 and 21. When the faster EMA crosses above the slower EMA, that signals a possible buy. 3. Trendline bounce. Draw a trend line connecting higher lows or lower highs. Buy or sell when price touches and respects that line. 4. MACD plus RSI combo. Wait for MACD crossover confirmation with RSI and oversold, overbought zone. 5. Candlestick plus support strategy. Wait for a strong candle, for example bullish engulfing, at a strong support level. Always test any strategy on a demo account first. Consistency and risk control matter more than the setup itself. Risk management, the one skill in trading. Risk management is the difference between surviving and blowing up. Never risk more than 1–2% of your account on a single trade. Set a stop loss every time, a level where you'll exit if the trade goes against you. Use the risk-reward ratio, RRR. For example, risking $10 to make $30, 1 to 3 RRR. This allows you to be profitable even with 40% win rate. Also avoid over-leveraging, using too much borrowed capital. Overtrading, taking too many trades in one session. Chasing losses, emotional revenge trading. The goal is not to win every trade, but to protect your capital and win long-term. Trading psychology, master your mind. Even with a perfect system, most traders still fail because of psychology. Trading will test your patience, discipline, ego, and emotional control. Common psychological traps: fear of missing out, FOMO, entering late and chasing price. Greed, holding trades too long. Revenge trading, overreacting to a loss. Impatience, forcing trades that don't fit your plan. To overcome this, you need a written trading plan, a clear routine, a strong emotional awareness. Top traders often say, you don't trade the market, you trade your mind. Journaling and reviewing your trades. Keeping a trading journal is one of the most underrated tools. Record why you entered the trade, what setup you saw, entry, exit, stop loss, and result. What you felt emotionally. Review your journal weekly. Look for patterns in your mistakes. Did you overtrade on Mondays? Did you exit early in fear? Your journal will become your best mentor if you use it. Next steps, how to keep growing. If you've watched this far, you've already taken the first step many don't. Now it's time to apply what you've learned. Here's your roadmap. 1. Practice on a demo account for at least 30 days. 2. Pick one simple strategy and test it deeply. 3. Study 1 hour a day, charts, videos, books. 4. Start journaling from day 1.5. Don't compare yourself with others. 6. Accept that losses are part of the game. 7. Trade with patience, not excitement. And most importantly, enjoy the journey. Trading is a lifelong skill. Learn it slowly, correctly, and you'll reap the rewards. Thanks for watching this beginner's guide to stock market trading. If this video helped you, make sure to like, subscribe, and comment below. Let me know what topic you'd like covered next. Stay consistent, stay disciplined, and never stop learning. Because in trading, your mind is your greatest asset.